Hi, you're listening to Market Matters, our market series here on JP Morgan's Making Sense podcast. I'm Dennis Burgers, co-head of EMEA Securities Services Sales, and I'm joined by Rebecca Wilmott, an executive director in our Securities Services Tax Custody Product team. Welcome, Rebecca.
Glad to be here, Dennis.
In today's episode, we're going to be focused on the securities taxation landscape in EMEA from a custodian perspective. The securities taxation industry seems to be at something of an inflection point. The rapidly transforming tax regulatory environment requires a heightened focus on data, but also on technology and tax risk management. Global custodians, now more than ever, must strengthen their positive and productive partnership with tax authorities and clients alike to ensure the continued delivery of an optimal tax service offering. There is, of course, no shortage of regulatory changes pertaining to taxes. Now zooming out just a bit, as global authorities have introduced further measures to combat tax abuse. Rebecca, I'm just curious, how exactly has the world of custodian tax grown in complexity?
It's an instance of simple cause and effect, Dennis. On the one hand, we see institutional investors have been trying to generate alpha. And to that end, they've been diversifying their investments, which means, and you can probably see what's coming next, an increased demand for tax services in new jurisdictions, and therefore consideration of new rule sets. Transparency is absolutely in. The reporting burdens have been augmented, but in parallel, there's been an ongoing uptick in the volume and complexity of tax market change. So custodians are no longer simply concerned with withholding taxes, but we're faced with now administering a wide range of other tax types. And not only that, new anti-abuse mechanisms have also required an agile response. So in a nutshell, global custodians and clients alike are experiencing heavier tax compliance obligations.
Got it. And I imagine that part of experiencing heavier tax compliance obligations means providing good tax data, right? That means cracking down on bad actors. I'm talking about those engaging in adversarial tax behaviors.
Absolutely. Through this increase in regulatory requirements, tax authorities are also calling on financial services to support their policing of these types of tax behaviours, and that's happening more and more. We're increasingly required to deliver well-governed client tax data. So to the point just being discussed, reliable data should always be the beating heart of sound tax compliance. And arguably inaccurate data in the context of tax can result in a bit of a logistical dumpster fire. So it's no longer enough to simply pay the right amount of tax. Tax authorities are now demanding detailed information on the claimants themselves. And the expectation is that that will in part be delivered by the custodial community as the holders of the CBOR, the custody book of record. Therefore, having robust client tax data, and not only that, an efficient and seamless mode to extract and deliver that data to both clients and tax authorities has become paramount.
That makes sense, Rebecca. Thanks for that. Custodians must seamlessly and reliably deliver client tax data. It's out with the bad actors, and it's in with transparency and compliance. Now let me ask you this. Whenever I hear seamless or frictionless, I wonder what tech enhancements are helping custodians deliver their client needs. So tell me, what's the role of technology on custodians in terms of tax?
Yeah, so custodians are focused on ensuring that the investor appetite for this real-time data we've been talking about and technology expectations of the moderators of our world are met. The purpose should be viewed as twofold. On the one hand, to enhance the client support model in an area that can be prone to risk, as we've discussed, but also to assist in ensuring compliance with this ever-expanding tax rule set referred to above. The critical question, as always, is where do we get the biggest technology yield associated with the delivery of our tax service offering? And not only that, that will help us further streamline and optimize the end-to-end tax processes. So to give you some examples, in the last few years, a common challenge in this space for custodians has been the need to respond to the ever-increasing trend of reclaim inquiry letters. So what do I mean by that? This is where we submit tax reclaims on behalf of our clients to tax authorities. And rather than refund those tax reclaims straight away, the tax authorities send inquiry letters. So they send detailed questions in some instances in relation to the reclaims, which we have to respond to. So devising efficient ways to manage those types of demands from an internal perspective has to be the priority. Ditto when it comes to devising technology solutions in tax documentation, a critical space. The ability to be able to digitally consume, review, record, and store tax documentation within our walls, also in a secure, streamlined fashion, is the way forward. So in all cases, when we're thinking about tax and technology now, a key priority is looking at the range of technology options available. It might be OCR, workflow, application programming interface, and more.
And what about AI and other newer forms of technology? How are they figuring in these discussions, and how are we seeing the tax authorities respond?
It's a good question, Dennis, and highly topical. Custodians, such as us, have found value in some cases partnering with technical providers and fintechs alike. AI has already played a role for some time in our space, particularly in the regulatory horizon scanning space. But we continue to look at it in terms of how it can ease operational burdens. So removing those non-complex, repetitive tasks, enabling us to equally redeploy partners. Likewise, in the case of blockchain, another newer technology, you could argue, the business case is sound. Having an immutable, tamper-proof record in the context of tax makes sense, but the industry just isn't there yet in terms of being able to create a blockchain-enabled withholding tax ecosystem. But those efforts continue. It's also worth highlighting, and this might be a surprise to some people, that the need for a sound tax technology strategy has been equally driven by the tech transformation on the part of the tax authorities themselves. That in turn has clearly enabled them to more deeply scrutinize the data that they're getting at their hands, which has also resulted in an easier path to investigations. So to keep up with the moderators of our world, the fiscal authorities of our world, we need to be at a minimum on an equivalent technology path.
That seems inevitable. AI is pervasive. With all of these advances, how do custodians mitigate risk?
Yes, all of this has to be considered now more than ever against the backdrop of requiring a really strong tax risk management focus. It must be acknowledged that there's an incontrovertible need in the current tax domain, compounded by a more hostile enforcement environment, to build a resilient response to mitigate the tax risks present. The response has to demonstrate a clear articulation not only of the tax risks there are, but accompanied by an efficient and practical plan to respond. So in that way, we recall the OECD's pronouncement of the concept of a tax control framework. It absolutely makes sense. Housing in one place all the tools, techniques, and organizational arrangements needed to ensure that not only are tax risks identified, they're assessed and duly mitigated.
So, Rebecca, what can we expect ahead? Will risk management and increased vigilance get easier? I know there's been a lot of recent regulatory work, including the FASTER directive that was approved last year. The new piece of legislation out of the European Commission.
Dennis, I'm glad you mentioned FASTER, which stands for Faster and Safer Tax Relief of Excess Withholding Taxes. I'm going to come back to that more in a minute, but we're continuing to see EU efforts to streamline existing withholding taxes across the region. We've long acknowledged that a key barrier to efficient withholding tax relief processing really derives from a lack of harmonisation in the EU. So as a region as well, not only do EU jurisdictions comprise the critical mass of a typical world index, but they also represent where the most withholding tax activity is generally required. So as a result, the current disparate rules set has been a common source of concern across the industry for many years, but it's not gone unnoticed. And there have been a number of efforts over the years to try and really improve the situation. And that's not just born out of concern around taxing. The current status quo also hinders cross-border investment, but also increases the cost of cross-border trading and generally acts as a barrier to achieving a single European market. So the position was arguably the genesis for the OECD's TRACE package. That stands for Tax Relief and Compliance Enhancement Package, which sought to provide a standardized approach to withholding tax processes. Finland was the first jurisdiction to go live in 2021, and others suggested they would follow. And in 2017, we saw the European Commission come forward with a code of conduct on withholding tax, again, really seeking to address the current and recognised inefficiencies in the system. Fast forward to 2020, and the Commission set out proposals, yet again, to deliver a streamlining of withholding tax processes as part of the Capital Markets Union Action Plan. Then followed a publication of a resultant impact assessment in 2021 and the release of a public consultation in April 2022. And matters really came to a crescendo last year with the FAST directive that we mentioned at the beginning. It's a substantive EU tax directive, and fair to say, it's going to change the face of withholding taxes in the region over the next few years. So there's a huge amount of work already underway for successful implementation before go live in 2030.
Well, there's lots going on in the EU in this regard. Any final words, Rebecca?
I just want to reiterate that the world of securities taxation is in a state of flux. Custodians have to be ready to deploy an agile approach in the face of the myriad of activity described. But clients also have to remain vigilant in order to maximize performance, whilst at the same time maintaining a rigorous compliance standard.
Well, that all sounds very great. Thank you, Rebecca.
Thank you, Dennis.
And thank you everyone out there for listening to Market Matters, our market series here on JP Morgan's Making Sense podcast.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. This podcast is intended for institutional clients only. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan, and do not constitute research or recommendation advice or an offer or a solicitation to buy or sell any security or financial instrument. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures. Copyright 2025 JP Morgan Chase & Company. All rights reserved.